After Friday's brutal tech sell-off, are we witnessing a true recovery, or is this bounce a trap?
The massive 12% drop in Micron on Friday really stands as the ultimate test of market resilience. Hello everyone, welcome back to AI Market News.
Section 1. Japan GDP and BOJ.
Based on available data, Japan's Q1 GDP was just revised downward from a preliminary estimate of 2.1% to 1.8% annualized. The underlying mechanism here is straightforward. A temporary dip in business investment tied to rising energy costs and climbing interest rates made corporations temporarily hesitant to spend on new software and equipment.
However, as you can see in the chart, the Nikkei absorbed this data exceptionally well. The index closed up 2.17%, effectively recovering roughly half of its recent 2,563-point plunge.
Section 2. Yen and USD Outlook. According to current market information, there's a 65% probability of the BOJ raising its policy rate to 1.0% at the upcoming June meeting. Furthermore, the graph shows the dollar-yen pairing remains highly sensitive to these policy expectations. If the BOJ decides to pass on the rate hike, that 160 handle remains very much in play, keeping intervention risks elevated for all of us tracking the currency.
To understand why this matters, we must look at the interest rate gap. If the BOJ does hike rates, it shrinks the yield difference with the United States. That places upward pressure on the yen, as global capital naturally flows back into Japan to capture higher relative returns.
Section 3. US tech stocks rebound.
Looking abroad, as you can see in the chart, both the S&P 500 and Nasdaq futures are pointing upward, reflecting a returning appetite for risk among investors after the previous session's sell-off. We can attribute this stabilization to two main catalysts. First, Iranian state media signaled an end to military operations, which brought down geopolitical anxiety. Second, Goldman Sachs established a new baseline, pushing their forecast for the first Federal Reserve rate cut all the way out to 2027.
It might seem counterintuitive that hawkish news actually helps stocks, but the mechanism is quite simple. Establishing a clear, even if pessimistic baseline for rate cuts reduces market uncertainty. Financial markets will always prefer a known worst-case scenario over the paralyzing unknown.
Section 4. The crucial CPI test.
Tuesday's modest rebound is merely a stabilization. The deeper structural questions regarding the market's trajectory remain completely unanswered until Wednesday's CPI release. That print is the real answer key.
For technology investors, the relationship between inflation and valuation is absolutely critical. If inflation stays hot, interest rates remain high. This directly hurts the valuations of AI giants like NVIDIA by heavily discounting the present value of their future expected profits.
Section 5. The week ahead.
We must closely watch the economic calendar. The critical US CPI data hits exactly at 10:30 p.m. Japan Standard Time on Wednesday. This is followed by producer price data on Thursday, and then the massive $1.77 trillion SpaceX IPO hitting the market on Friday.
The risk surrounding SpaceX is a matter of capital absorption. Raising $75 billion requires massive institutional cash, meaning capital could be siphoned directly out of existing tech stocks, providing a severe test of the market's true depth and liquidity. With inflation data, BOJ policy, and a mega IPO colliding in a single week, the question isn't just if tech will bounce back, it's whether the market has enough fuel to sustain it.
Thanks for watching. Please subscribe and hit the like button.
This video was automatically generated by NotebookLM AI. AI-generated content may include errors. This video does not constitute investment advice. For full details, please check the description below.